Hello, everyone. Welcome back for another Friday Fratarcangeli update. We're going to take this opportunity in the last month of the year to talk a little bit about some of the deadline planning as we close out 2025 that we should be considering. So here we are in the last month of the year, looking at what we should be doing before December 31st, the deadline to make some changes. The first thought would be tax harvesting. Those of us that have accumulated capital gain sales, whether it be in our investments in mutual funds or individual stocks or our businesses, if we've created capital gains, understanding that we can, prior to December 31st, take a tax loss on an investment that's long-term to directly offset against that capital gain that's been realized. If we can get that addressed and executed upon prior to December 31st, we can control our tax burden that will be due coming in April of next year for 2025 taxes due. So very important that we're on top of these deadlines. In addition to that, we are also focused on the different changes in the laws that are coming from this big, beautiful bill that was introduced on July 4th that is taking place for the entire year of 25. For example, charitable contributions. Those of you that are making charitable contributions historically and plan to in the future, it's important to note that we are going to lose part of the deduction starting in 2026 for those contributions. And the deduction is going to be impacted by approximately 10% of that deduction due to two major changes. One, your ability to deduct on that charitable contribution on anything below 0.5% of your adjusted gross income. The second change is that we're only going to be able to deduct up to 35% of the tax. And if we're at the highest tax bracket of 37%, that's a 2% loss in deduction. And if you combine the two together on charitable contributions, you're going to lose about 10% of your deduction. So if we plan on making donations in 2026, it would make some sense to invest in and donate to something called the Donor Advised Fund. So what you're doing is you're making the donation to a donor advised fund, taking the deduction in the current year, and then actually making those contributions to whatever charity that you choose throughout the coming year and years to come. But you can make the contribution to the donor advised in 2025, get the full deduction, and then be able to donate in the future based on those changes in the deductibility. That's something I would strongly recommend you look at if you are planning on donating in 2026, but yet would like the maximum deduction. In addition to that, we also have the big, beautiful bill that gives us the opportunity to take 100% depreciation against income for anywhere from small businesses all the way up to large businesses on purchases made that are going to be used for that business in a fashion that's going to allow that business to essentially operate at a more efficient pace. It's going to motivate businesses that know that they're going to be spending money to grow their business, to take on machinery or any type of technology, to make those purchases prior to the end of the year to offset income that would be taxable in the current year. On the investment platform, this is something that is extremely compelling to the positive impact that that's going to have on corporate spending, as well as earnings growth out there for many companies that'll benefit from those purchases being made, whether it be to technology improvements or large machinery purchases that's going to help that company in their next phase, that they're going to utilize the purchases in the current year to reduce their taxes. So one, reducing taxes. Two, creating economic activity that should bode well for earnings and growth in the marketplace. Very powerful things that those business owners out there may want to consider that I'm watching firsthand with the business owners that we work with. Another thought that we should consider with this new, it's big in the news these last couple days with a donation coming from the Dell family. There's a new child contribution from the federal government to the tune of $1,000 into a Trump account for all newborns born between 2025 and 2028. That's going to be put into an account for the child born and be invested in the S&P 500 to allow it to grow for the future. It's also going to allow parents and other folks attached to these young kids to make contributions to the same account. and have that grow as well. And that account could be utilized for a number of different needs that that child could have in the future. So it's a great opportunity to get our children to start thinking down the line why they were taking advantage of this government $1,000 contribution and how that might have been utilized for growth as well as for future needs that the child has, and get them in the mindset of saving and investing. We at our industry, as well as Fratarcangeli Wealth Management, have used similar accounts to put money away for children, our children or our grandchildren, something called a UGMA account that also has special tax treatments that we can contribute to for our kids, either from the gifts that they receive or simply making investments for them that has special tax treatments in the years that that money will grow, as well as the ability for them to save money for the future. In addition to that, there's education plans that we've utilized called 529 plans that have contributed to and allowed to grow over time, can be utilized to pay for private institutions in grade and high school, as well as college and upper education, trade, and other more flexible ways of paying for education for our children. And as that money gets contributed and then invested, it grows tax-free if used for higher education. So another great way to put money away, and I think getting that mindset for our young next generation to understand what investing means and some of the benefits of doing so. Those of you like myself that had some part-time jobs in the summer, starting at age 15 and having jobs all the way through college, if you're making an earned income as an individual, even as a part-time worker, you could contribute to retirement accounts like Roth IRAs and IRAs, and how that money can be utilized to grow more tax efficiently. So these are great vehicles to start educating our younger generation, showing them how to invest, and I think it's a great new thing to show the kids with this new Trump account and the ability for us to contribute with them. And those out there that are philanthropic, like the Dell family, contributing to every child born between 2025 and 28, $250 each one coming from a family that has that ability and the dollars to invest in our future. So very powerful things out there for us all to consider. But we want to make sure that we're thinking ahead, because come December 31st, the ability to offset taxes, the ability to make purchases that are going to reduce taxes for the corporate world, these things will go away. And unfortunately, we'll miss those deadlines and our ability to mitigate taxes. So just keeping us all on the forefront thought process as we enter into December 31st here at Fratarcangeli Wealth Management. We are very focused on preparing, planning, communicating, and making sure that we're considering all of these factors. That being said, I thank you all for joining me today. I look forward to seeing you over the next week or two, getting us all prepared for year end and coming back to you with the Fratarcangeli Friday update in 2 weeks. So thank you all, and I'll see you soon. Bye for now.